In our second segment today, Real Estate 101, sponsored by the coastal team of Keller Williams Pacific Estates. This talented group of real estate professionals will give you the 411 and be there if you need the 911 during your home buying or selling process. Give them a call at 562-888-0404. And today's topic for Real Estate 101, the pros and cons. Wow, this is more mortgage, but that's okay. The pros and cons of a 30-year fixed mortgage.
Well, this should probably be me since I know you're.
Did you just lay down a boom? she goes boom. I think that's the. I'm gonna take this one.
You know, I think this is kind of relevant right now, just with the fluctuation of rates. A lot of people are starting to consider ARMs, and I get asked this question a lot, so I thought I would bring it up. Pros of a 30-year fixed. Number one, bottom line, you're going to have. Versus a 15 or 10 year. I'm going to say this as well.
Okay. Fixed rate, reduced term.
Fixes, versus a shorter term. Okay, your payment's going to be less. Okay, just off the bat, because if you're doing a 30 year versus a 15, you're trying to squeeze in the same amount in half the time for a 15 years, so your payment's going to be higher. Two, and here's kind of what I always say is, look, things happen, life happens, transmissions go out. Cats get run over. Oh, that's horrible. Things happen to pets.
There you go.
Basically large expenses happen. Blow time. So what you can do, a 30-year fix, you can always pay a mortgage as if you have a 15-year. Yep. You can never pay a 15-year as if you have a 30.
You can tell them that at the time of their loan. You could say, look, if you want to make it a 15-year loan, pay X amount.
Right, pay X amount of dollars, because you know what, crap happens, and you never know.
Yes,
what may happen in the future where you may no longer be in a position to be able to afford the higher rate.
But if price or if monthly payment is of value to a 30-year fix, then why is a 30-year fix better than an adjustable? Because that payment is even less, right?
Well, an adjustable, and maybe this is a pro, something that Scott can come in, but one good thing about adjustables, you got to really see what your goals are. If you only plan on being in the home for X amount of, most people refinance maybe every 4 to 5 years. Okay, so if you don't plan on being in the home for over 4 to 5 years, why are you going to get a 30-year fix if you can get an adjustable?
I think the downside on top of that is what just happened to us a few years ago,
a lot of
which is people
really
gambled. People mismanaged. People didn't understand their loan.
Yep.
People bet on saving money within that short arm term, and instead went out and instead of saving that balance of what they would have paid on a 30, went out and bought the jet skis, bought the honey, the matching Escalade or whatever. Okay, and when the adjustment time came, values were down. There was no equity to be found. How do you refi? How do you get out of that situation? You don't.
So in the case of an ARM, I would say if you don't plan on being in the home for that long, that may be something you might want to look at.
Yeah.
So those are kind of the pros, basically cheaper monthly payment, and it's a good safety net in case something happens in the future where you can no longer afford that shorter term payment. Cons, you may be paying more. You will pay more interest.
Oh heck yeah!
The longer you're paying and longer you're that mortgage, the longer you're going to be paying interest, and that's costs money.
Is there any example on the top of your head you can come up with of like whatever price house you want to figure out how much more interest you pay on a 30 than you would on a 15?
Off the top of my head.
I know.
Well, if you look at an amortization table for a 30-year fixed,
there's tons of calculators out there too.
Yeah, you're paying about twice as much as you bought the home.
In interest.
Usually when I see,
fix.
like on a till, I'm usually seeing at least double.
Yeah.
So what your price is at the end of the 30 years, double that, and that's usually right around.
Yeah. So for the convenience of having that low payment every month, you really pay an enormous amount of interest.
Yeah. Let me throw a couple more things in there. Also, FHA really threw a wrench into this whole thing. Because if you get a FHA 30-year fixed right now, you are paying mortgage insurance, which is, it's tax deductible now, but that was a special exception for last year, and this year it's tax deductible.
Yeah, so who knows if it'll continue to be
Who knows if it'll continue, but now you're stuck with FHA mortgage insurance for the life of the loan. That's not going towards principal. It's not going towards interest. It's just an insurance policy that could be a couple $100 a month. So most people are going to want to get out of that. So an ARM is a safe vehicle for for putting yourself on a 5-year plan to dump your mortgage insurance. So if your only option is FHA due to whatever reason, make sure that you, and I'm not saying you automatically do it. I'm saying have this conversation with your loan officer. Make sure your loan officer is having a conversation with you about all the pros and cons. And I think that's all we really ever talking about here is to expose you to enough of the insider stuff that we deal with all the time so that you can have these conversations or start these conversations with your loan officer. And if they're avoiding the conversation, then there's a red flag for you.
Yeah, anytime they avoid.
And there you go. It comes back to your lenders, your mortgage lender's understanding of it and their detailed explanation to you, and you understanding it, and you working together, and keep communication with that lender. And if you do it right and you understand how to manage it, I mean, you can take advantage of 5 years, 7 arms, or even the 30. I mean, just know what you're getting into.
The last thing to keep in mind is that adjustables don't always go up. During this crash, adjustables went way down. Yeah. And so people whose loans adjusted, they actually went down. And I know a lot of people that had arms that I advised them just stay where you're at because it's going to adjust once a year, and they are at absolutely record low rates for a while. Ride this thing out until there's more options available in the market. So it's not a super volatile product.
I saw something crazy I need you to answer for me. Do you end up paying interest on insurance?
Mortgage insurance, upfront mortgage insurance, you do.
So you end up paying interest on the insurance being rolled in. That's crazy.
The upfront mortgage insurance of FHA, because it's added to the principal balance, and then you're paying mortgage insurance.
So FHA isn't really as good as it looks.
It is as good as it looks for people who that's the only thing they qualify for.
Yeah, to me, it's like going to bed with a 10 and waking up with a 5, but that's just the way it works. Wow. Yeah.
That was your bad.
That's
actually your wingman's bad.
That was my bad?
That's your wingman's
bad. Does that remind you of a girlfriend you used to have?
Yes, exactly.